Hey everyone, welcome to Simplifying Investing with me and me.
Hello.
So we are recording the day after the Reserve Bank's November Cup Day decision. Half yours won the Melbourne Cup, but the RBA didn't even give us half yours or quarter yours. They gave us nothing yours because they kept rates unchanged at 3.6%.
I mean, this was not really a surprise. Every single economist, I think 35 economists surveyed by Bloomberg, all put in a hold for the RBA. This is unchanged from last time they met in September as well. And obviously, this was also a unanimous decision from all 9 members of the monetary policy setting board from the RBA. So it seems like on the surface, it does seem a bit like a non-story to us that, they're not doing anything. Nothing's really changed since last time. But I guess there was definitely quite a bit of commotion about the RBA, and that's definitely from the 70-page statement on the monetary policy that they released yesterday.
So what is the statement on monetary policy?
So it's basically a set of essays, I would say, about the outlook for the Australian economy. Where does the RBA think the risks and the outlook for the economy is going to? And the most important is that they give us a set of forecasts for GDP growth, inflation, trimmed mean inflation, as well as employment and unemployment forecasts in the next 2 years. And that's definitely the thing that we cared the most about when we had to, ramble through the 70 pages within 15 minutes of the release of the RBA. I think this time people were rather concerned reading those 70 pages because the RBA upgraded their trimmed mean or core inflation forecast massively. If we believe the RBA's forecast, we're going to see trimmed mean inflation above their target band, basically above 3% throughout the next 6 months or so. And this is with cash rate basically being on hold throughout the first half of next year as well. In the meantime, we'll see unemployment rate ticking up a little bit to 4.4% and settling there. So what is this set of forecast telling this to us? The RBA has many times reiterated that they don't like to see inflation above 3%. They want to see inflation somewhere around 2.5%. So with this set of information, we basically can think that they probably won't cut anytime soon. We're probably going to see high inflation in the near term, rather weak growth around 2%, but no rate cuts.
So the Reserve Bank Board has a dual mandate. One is price stability. That means inflation between 2 to 3%. But really, they're telling us they have to get inflation at the midpoint, 2.5%. Michelle Bullock yesterday, the RBA governor, said that that's sort of a non-negotiable. The second part of their dual mandate is full employment. So basically keeping the unemployment rate unchanged. Now, in the month of September, we had the unemployment rate increasing to 4.5%. And from the RBA's perspective, if you read their commentary yesterday at the meeting, was that they're not too concerned about that. They think that conditions in the labour market are going to go back to an unemployment rate that's a bit lower. They think things are still fairly well balanced. Actually, they think, in their words, that the labour market is still tight, which basically means that there's more demand for workers than there is the supply. So they're not concerned that we're going to see this big increase to the unemployment rate and job losses. To me, I think that that's the biggest source of contention that I have with the Reserve Bank's forecasts. When I look at the forward-looking indicators of jobs growth, like job indicators, job ads, I think that there's more upside risks to the unemployment rate from here. I really worry about the transition from public sector jobs growth, which has been driving labour force, versus the private sector. I'm just not seeing that much demand coming from the market sector, private sector, and the non-market sector is going to soften. We know that. The government's been telling us that there's going to be softer jobs growth related to healthcare, education, public administration. And I think that the Reserve Bank is underestimating the risks to the labour market, but I find it very difficult now to see the Reserve Bank cutting rates in the next few months. I mean, obviously, we're not going to get a rate cut before Christmas. That will make some people probably a little bit sad, obviously, because about a third of households have a mortgage. And given that we had numerous rate hikes in the past, in the 2 years prior to 2025, I think a lot of people were hoping for a bit of Christmas relief. And we're not likely to get that. And I think it's hard to be confident about if we are going to get a rate cut again. I mean, we still think that we will at some stage next year, but it's hard to see one happening in the beginning of 2026. So rates are probably likely to remain unchanged at current levels, 3.6% for a while. That means mortgage rates are going to remain unchanged, about 5.5% for a variable rate for the foreseeable future too. And for those with the mortgage, it means that the current rates of repayments that they're making are not going to fall anytime soon. But I don't think we're going to get rate hikes from here. I think the probability of that is still pretty low.
I mean, I agree. I think the arguments for rate hikes is that people think that the labor market is just too tight and it's hard for companies to find workers nowadays. And the RBA likes to give that as an example as well. The RBA kept reiterating this example of when you try to find tradies to do your renovation, then it's really hard to find them. I
feel like that's the only example that
that's the only example. So I do find that quite funny. You know, if you look at job ads, especially in industries like, say, financial services, they are definitely still down. Market sectors, wages growth. IT? Yeah, market sector wages growth actually falling. And I guess, you know, the RBA likes to say this too. They say that on balance, even with a 4.5% unemployment rate, they think that the labor market is tight. But I think on balance, when you look at more market cyclical sectors, there's definitely some easing, some deterioration in there. So I guess the key here, if we want to think about what's the next step for the RBA, to be fair, the RBA doesn't know. They don't have a crystal ball either.
Yeah,
is that we have to look at two numbers. One is probably where the unemployment rate is going to go from here. So our forecast at AMP is that it's probably going to settle a little bit higher than what the RBA thinks. We think it's going to go up to around 4.7% or so in the next few years. It's not the end of the world to see 4.7% unemployment rate because it's still below where the pre-COVID level was. But I think if we see that sort of breakout in the unemployment numbers, then that probably can give a bit of room for the RBA to cut sometime later next year.
So what does it mean for you? I guess, if you are a homeowner, we've already spoken about that, you're not really going to get much relief on your mortgage. We know that consumers on average are paying about 12% of their disposable income on their repayment. Now, this is for all households. If you have a mortgage, it's going to be a much higher rate than that. But don't forget that a third of households have a mortgage, a third rent, and a third own their home outright. For those that are renting, I don't really think that the RBA decision has much of an impact. Rents are still elevated, mainly from the supply issues that we have. We don't have enough homes. For those who rent, I think rents are still going to remain quite elevated because the major issue driving rents up is the lack of supply of homes in the market relative to demand. I think some people were hoping that if we got a rate cut, the landlords would pass that on to the tenants, but rents don't move quickly. They usually move every 6 to 12 months. They are not a very cyclical type of industry. They are more sticky. And for those that own your home outright, well, it doesn't really mean much for you. I guess it does mean that term deposit rates aren't going to fall too much further. So if you're saving, then that's good news for your savings accounts. But for the share market didn't like the news that the RBA was not going to cut rates anytime soon. Share markets tend to go up on news of lower interest rates. So for investors, I'd say that it's a slight negative that the RBA is not cutting rates as quickly as we thought that they may.
Actually, for the homeowners, I think there's a little bit of implication though. Last week, we actually saw home price growth in Australia accelerated to the fastest pace in 2 years, accelerated to 1.1% over the month. So over the last 12 months now, home price have grown about 6% or so. I think a delayed RBA rate cut, or basically no RBA rate cuts, just means that whole acceleration in home price would slow a little bit. So home price will still grow just because of our long-term supply and demand issue, but it probably won't grow as fast of a pace compared to October. Let's move on to the next asset class, actually. Over the past 2 weeks, we've seen a bit of a drop, not just in shares, but also in Bitcoin and in gold. Gold has fallen 9% from the October peak and is now below that $4,000 per ounce threshold.
Well, shares haven't fallen that much. They've sort of been flat-ish in the US in the past few weeks, a bit of a dip, but they're still at very elevated levels. The gold price and Bitcoin has fallen by more.
Yeah. So what do you think happened? It seems like the bubble has popped. Do you think so?
I think some froth has come out of the market. I walked past the ABC gold bullion store today and there was still a line, less than it was 2 weeks ago when I did an interview with the ABC, but there was still a line there. I think that there is still some demand for gold from retail investors, but I think some of the institutional demand has probably softened a little bit because it did get a bit too bubble-like. Longer term, there are still factors that are going to help the gold price lift further, I think. So those things are more central bank buying of gold, which has still been pretty elevated. I think that the debasement trade has further to go. So lower US dollar, lower US bond prices, and more positives into gold and Bitcoin. The second factor is the debasement trade. So the debasement trade has been a word that investors, I suppose, or the market has come up with recently, which is basically to indicate that there's not as much demand for the US dollar in the long term, or investors are concerned about the prospects for the US economy, the US dollar. They want to hedge away from risks around inflation, US debt issues, and US geopolitical related things. So they're buying into assets like gold and Bitcoin as a hedge away from some of those factors. And I think most of it is probably around politics and this expectation that the US is probably no longer going to be exceptional. So that drove a lot of the increase to gold prices recently, but I think that that trade has further to go. So obviously this is not personal financial advice, but I still think that gold has upside. In the short term though, it can definitely fall a bit further.
I mean, I do agree with you because if you look at, say, gold demand over the years, the bulk of demand actually comes from central bank rather than from institutional investors. So lately, that drop has definitely been driven by institutions offloading a little bit as they see mom and pop investors queuing. But that pace of central bank buyings, I don't think is going to contract anytime soon, especially as emerging market countries try to diversify further away from the US dollar, as you said. And I guess when you mentioned, the threat to US credibility, that probably is still going given that the US government is still shut down at the moment. I think we've gone on to the second month of shutdown now.
Yep.
So by all means, that trade definitely still has a little bit further to go, even though in the short term, we might still see more noise. A little bit depressing if you want gold in the past 2 months.
I guess for shares though, in the next few weeks, there's probably the risk of a bit of a dip. The earnings growth for the September quarter was fairly good in the US. Some concern over AI stocks, though. We've seen a bit of a pullback in some AI-related areas. The government shutdown's still ongoing. We may actually get more downside in markets due to that because there'll be more pressure on the government to reopen quicker as people are missing more payments. So it's quite easy to see a bit of a pullback in share markets in the next few weeks before Christmas.
But offloading that is positive seasonality as well. Historically, November has always been the best month for US shares. Before people, go on holidays in December because people try to wrap up the year with a positive number. So I do think that, yes, valuation is very elevated and there might be some risks in the near term, but I think going into year end, it probably would turn a bit more positive though.
So Mei, what was your favorite news story of the week?
Not exactly a news story, but probably a little numbers that I've crunched earlier this week. So over the last quarter, we've seen household spending in Australia slowing a little bit. It only grew by 0.2% in volume terms.
That's pretty weak.
That's pretty weak because that just means that per person, people have probably spent a little bit less based on the ABS indicator. But one good numbers out of that is that we've seen a 7% quarter-on-quarter drop in alcohol as well as tobacco purchases. Some people say that it might be because people are just turning to illegal shops and illegal tobacco shops to buy because of the high excise tax on tobacco, so that it's not captured in the official data. That's why you see that massive drop. But then, I guess, coming from someone who doesn't smoke and who doesn't drink that much, I feel like maybe it's a good thing because people are just probably becoming a bit more health conscious now. You know, Australians always have this reputation of being very health conscious. You eat quite healthy, and young people are now congregating at the local froyo shops. And the hottest trend right now is yochi, rather than going to bars and clubs.
I think yochi's hardly healthy. It's still got a lot of sugar in it, even though it's frozen yogurt. And all those toppings that you get at yochi are far from healthy. But yes, maybe rather than binge drinking, maybe it's better to go
or binge smoking.
To yochi. Or binge smoking is better to go to yochi.
Anyway, that's my feels good story of the week. So I think we should just end it there. Ends with a good note. See you next time, Diana.
See you next week, May.